It's fantastic to welcome you all to this webinar. My name is Nelson Phillips, and I'm Associate Dean of External Relations for the Business School. And it's a pleasure to have the opportunity to open this webinar. This is a fantastic next step in the development of the center and in the climate change work that's going on at Imperial and at the Business School in particular. Once again, a couple more people have joined. So once again, welcome to this first report that's being presented at the webinar from the center. And I just wanted to say a couple of things in addition to, of course, the welcome. I just want to talk a little bit about why I'm so pleased that this event is happening and why I'm so pleased with the work that Charlie and his team are doing in the center and doing with this great partners like Standard Chartered. Imperial College, as many of you may know, was founded with a particular focus on doing practical things, on solving practical problems. And there is no more practical and pressing problem right now than climate change. So the theme of this center and the theme of this report are absolutely key and central to what Imperial College does and to what Imperial College Business School does. We have a number 5 key strategic themes that we are pursuing as a business school in terms of our research activity and our broader outreach to the business community and the government. And one of those is, of course, climate change. So the center that was founded by Charlie 4 years ago is key to our work in this area. So really excited to see this next step in the development of the center and next contribution from the researchers at Imperial and Imperial College Business School to this question. This is also really, I think, a really kind of classic event. Of course, we're virtual and welcome you virtually to Imperial College and to Imperial College Business School. But this kind of event, working closely with all kinds of practitioners, of managers, people from government, is so key to what Imperial is. Imperial and Imperial College Business School, we're really extremely focused on, as I said, practical problems and on working with people from the world of practice, people who can take research ideas and research results and actually do things with them. So it's so fantastic that you're all here today to hear about the recent work and to help us put these ideas to work and to work closely, hopefully in the future, with the center as we move forward in this area. I was just talking with Charlie before we started the seminar. And it's really exciting to see this. 4 years ago, four and a half, 5 years ago, we started the conversation about the center. 4 years ago, the center was formed. Now the center's getting awards for the work that's going on. It's connected with a ton of businesses and government departments and things, and all kinds of stuff is happening. This fantastic journey towards what I think is one of the most key problems in climate change. What do we do? What do we do about all this kind of the financial aspects? What's going to happen? How's it going to work? How are we going to manage it? These are really key problems. So I want to thank the corporate partners that helped make this possible. I want to thank all of you for being here. I want to really congratulate Charlie and his team at the center for the next step in developing the activities of the center, the first of a number of reports that will be coming out. So hopefully you'll be able to join us for a number of other webinars as future results appear. And I just want to really say, I think it's great that we can get together a group of people and continue to advance the climate change agenda. We have been in the last year somewhat distracted by the pandemic, but this problem hasn't gone away and we have to get back to it. And this event, I think, is very timely because hopefully with the vaccine, we'll be moving a little bit away from the pandemic and be able to refocus 100% on this problem, because this is still there and it's bigger than ever. So I'm going to hand it over now to Charlie. Look forward to hearing the results. And once again, thank you all for joining us. Charlie.
Thank you, Nelson, and really great to have those kind words about our work. And I just want to echo first and foremost, say a big thanks to Standard Chartered. The relationship is now 6 months old, so this kicked off in the spring. It's framed as a 4-year partnership, which we hope will last well beyond that. To really try to drive into the insights that are necessary so that the financial system and banks in particular can really move on with the potential. And the great potential is to leverage all of the great capabilities in organizations like Standard Chartered towards this common cause. And the problem that we hear time and time again, whether it's banking or asset management or private equity, but there's a common problem. And that problem is, how do I move from scenarios and let's say very simply a knowledge base around climate and what's happening around energy, and translate that into the kinds of risks and opportunities that I recognize as a bank or as an asset manager or as an asset owner. And that process of translating is not an easy one. And I think that anybody who's been involved in doing that would agree that there are a number of steps along the way. There's a lot of complexity. There's a lot of uncertainty embedded in that. And there's a lot of a political economy that says, even if you could make a great model, you're still going to have to deal with the reality of how things work today and sources of resistance that come from many sides. So we're really proud to have this to be the first piece of work. Our plan in this research activity is to release a report of this nature about once every 6 months, moving really around the world and focusing specifically on emerging markets to try to bridge that gap. And so without further ado, what I'm going to do is hand it over to Alex Koberly. Alex is a research fellow at the Grantham Institute at Imperial College London. Has come into my team over the last 6 months and will be with us for, we hope, a long period of time as well, in order to head up this public-facing work. And I'll let Alex talk about his background quickly as he runs through a slide deck, which is going to give you the highlights of the report that we've released this morning. And at the end of the presentation, we'll provide links for where you can access the report on our website. After Alex provides his overview of what we've got in the report, we've invited a number of colleagues to reflect on what they see there and really start to explore what are the challenges in this specific sector of electric power generation in India, which, similar to a number of other countries, South Africa, Indonesia, Vietnam, and to maybe a lesser degree, China, is in a bit of a bind, in that there is a huge installed capacity of a technology that is quickly becoming uneconomic. And finding solutions to that is not just a necessity for climate change, but is really a development imperative. It's an economic imperative. And so this really crosses a number of important domains that I'm really pleased the folks who are with us today can shed some light on. So with that, welcome. And Alex, let me hand it over to you now to go through the main findings of the report. And then you can hand it back to me and I'll introduce our panel and we'll take it from there. Can I say, as we go along, for those of you tuning in, really happy for you to put questions into the Q&A or into the chat. And at the very end, I will draw on those questions as we go through with the panel discussion. So please do feel free to put in your questions. And if there are things specific about the report that we can't get to in this session, we'll certainly do our best to follow up with you by email about them. So I encourage you as much as possible to try to have an interactive session. Alex, over to you.
All right. Good morning, everyone. Thanks, Charlie, for the introduction. As he mentioned, I'm a research fellow at the Grantham Institute, working also at the Center for Climate Finance and Investment. And my background is in energy systems and climate change modeling, and produce the kinds of scenarios that you see in, for example, IPCC reports. And they're more geared towards informing policy rather than financial decisions. So they are not necessarily built to answer the kinds of questions that we are trying to address here. So there is a need to here we go. There's a need to bridge this gap between what's the box on the left, techno-economic assessments of energy system models, for example, and the kinds of financial assessments that financial institutions would be interested in. So what we've done here, we've taken an energy system model and we have produced a, I don't know if, can you see my laser pointer? And we have bridged this gap to produce a pro forma cash flow model for 3 of India's largest coal-dependent firms. And these are Coal India Limited, India Railways, and NTPC Limited. These firms are facing challenges from policy, as Charlie mentioned. Climate change is definitely an issue, and reducing emissions is going to be a priority going forward. But also, from an economics side, the falling cost of renewables are starting to put considerable pressure on coal assets in particular. But in addition to those two, I'll also flag that there are other environmental concerns regarding coal. For example, local air pollution regulation, which in India is about to come into force in a much more significant way. Of course, COVID has delayed that a little bit, but it's eventually going to happen. So, and that also pushes the financial performance of a lot of, particularly the old coal power plants, into question. So what we did, we took an energy systems model and we developed two scenarios. One is just a trend scenario, which is a likely evolution of the power sector and resulting coal demand from that. And it assumes that the National Electricity Plan target of 175 gigawatts of renewable energy, the target is before 2022, but we gave it a little bit of slack and we said that it will be met no later than 2025. This is the only constraint that we put into it. The rest is a cost optimization model, so to give you a solution for the whole energy system, a cost optimal solution for the whole energy system. And the only thing we forced it to do was this. And then we have an aspirational scenario, which takes on board the 450 gigawatt renewables by 2030 that Prime Minister Modi announced last year at the UN Climate Summit. And we used the Times India model to develop these projections. These, just quickly, some results. These figures are all in the report. I'm going to go through them and kind of point to some key aspects of a lot of these figures. It's just a way for you to a bit of direction on how to read these figures and what's important in them. So this is the generation capacity and electricity generation. So going from 2015 to 2035. And blue and orange are wind and solar respectively, while the pink is coal. So we see as we move forward in these two scenarios, going from the trend to the aspirational, there's a considerable reduction in both the capacity and the generation from coal power, and a rise in renewables. This causes a reduction in coal demand, and also a reduction in the coal that is utilized by power plants, of course, because of this falling generation, and also because the fleet of coal power plants is getting more efficient. So there's two factors there that are pushing demand down. So the question then becomes like, so how do we take these results, which are sector-wide results, very aggregate, large-scale results? How do these changes affect the firms in question? How do we translate this into relevant parameters for particular assets that we're interested in examining? And this is the objective of the long-term research agenda that we have here. This is one example. What we did here is one example of how to do this. We have other work that we've published that use other tools to answer the same question, but broadly, this is what we're trying to address, is bridging this gap between these two disciplines. And there are several tools that can help you do that, and they'll have advantages and disadvantages, and it's very important to understand the tools very clearly if it's going to be driving forward business decisions, particularly strategic positioning of a financial institution. There has to be transparency, there has to be understanding of what this tool does. So there's a considerable amount of model risk that has to be addressed here. So how do we do this? So basically through scenario expansion, but it's a bit of a different kind of scenario expansion. It's not just taking the aggregate macroeconomic variables and producing more granular results for that. You have to actually go into the actual operating environment of the firms in question. So we explore two possible, and so actually first we need additional assumptions to understand how these things translate down to the operating environment of the firms. But also it's important to understand how these firms may respond to these changes. They are not going to be statically sitting and doing the same thing they were doing in 2020 when they, as we move forward. So we analyzed a couple of these options, and we call them a response A and a response B to the changes that we see from the trend to the aspirational scenario. So there's four things here that you keep in mind. There's two scenarios, but then there's two types of responses to the changes. And this is what can be a bit confusing on first read of the report. But I think that if you understand that, then it'll become much easier to approach it. So for NTPC, the response A is just to continue implementing its current plan, which is the Brighter Plan of 2032, which goes up to 120 gigawatts of new capacity. Sorry, 130 gigawatts of new capacity, and of which most of is new coal capacity. It's response B, which is to take on board some of these changes and try to align the future more with the changes that we're seeing, would actually reduce the new coal capacity and start deploying more renewables. So there's just a bit of a shift on the new capacity that comes in. For CIL, for Coal India, the basic response is to just maintain its 83% domestic production of the domestic market, so of the production of coal, irrespective of the evolution of coal import levels. So just keep its domestic production share, and its more alignment response B, is to increase its domestic production to actually displace new coal imports. And this means that new demand will not be met by imports, but by national production by Coal India. So the imports remain at 2020 levels as a result. For India Rails, which is a bit more complicated analysis, and this is the one that we had to make a few more assumptions. The first response is to do nothing, and the percentage of its revenues that are coming from coal have been falling in recent years, and this just assumes that it will continue to do so. And the response B, which is to try to align to this falling demand domestically, would be to utilize the spare freight capacity to transport other commodities, just to shift commodities. So just go quickly through some of the key results. This is for NTPC. We can see on the left is capacity, and we see the shift from, here's a trend scenario, here's a response A to the change, meaning do nothing, right? Continue along the path that was defined by the Brighter Plan. And response B, just change the composition of the new capacity that it will build between now and 2030. This entails different generation mixes, and in any case, there's a reduction in the amount of coal power that's generated, but because there's less expenditure here on the capacity side, the losses aren't as large. There's not so much of impaired assets that happen going forward, and these are the results for the pro forma cash flow projections along these three. Because of these different energy system changes, this is what happens on the financial side. So this is this figure in the next two, this slide and the next two slides are all part of one figure, figure 11, that summarize these energy systems on changes on one hand, on the left column, and on the right column you see these cash flow projection graphs. And this is the case for Coal India. Again, we see the trend it just continues along its path. Its response A means that its production is going to go down because of falling demand, and its response B recovers some of those losses. And this has different implications for its cash flow projection. So these are indexed to 2020. So 2020 is 100%. And so there's an increase, but then there's a long-term decline in revenues from coal production going forward as the energy system shifts from coal to renewables. And also because of the coal fleet improvement in efficiency also drives down coal demand. For India Rail, the picture is more stark. India Rail is already facing significant financial issues even in the trend scenario. So this is the challenge here, is that even its trend scenario cash flow is problematic unless it does something. We're assuming here, of course, that there isn't a big intervention into Indian Railways operation strategy, but this can change, but it would take a shift in how things are done today. And what we're finding out is that with these changes that happen in the energy system, the losses that are coming in from India Rails are exacerbated. So India Rail could suffer even greater losses from from these changes, then if it does nothing, interestingly, its response B, which is shifting away from coal, starts to recover some of those losses already. So this is an interesting insight that can be brought on board. Like maybe it's a good idea to start depending less on coal. And of course, this is nothing new, and the other reports that show the same thing. But it just we're in line with these other results. So this is just a summary. So table 3 summarizes the cash flow at risk findings, and we see that in response A, so we were looking at the percentage, can be significant for NTPC, and it's like 16%, but it can be also recovered by proper alignment. So there are things that these firms can do to minimize these impacts of these losses in cash flow. For NTPC, it's a bit smaller, and it can also be recovered by proper, adequate strategies. And for India Rail, we don't provide a number because the trend scenario already has a negative cash flow. So a cash flow at risk from a negative cash flow doesn't really make much sense. So we decided to just call it not applicable here and leave the analysis to be more on the qualitative side. But it is important to show that an appropriate response will actually recover all of the losses that could occur from these shifts in the energy system from arising renewables. So with that, I come to just some conclusions, some high-level conclusions. There are more detailed conclusions that you can find in the report. First, there's mounting pressure on coal value chain in India from renewable energy development. And it's just because of both falling costs of renewables and also because of public policies in both, not just climate, but also in local air pollution policies. Financial institutions and the government and the sovereign could both lose in a scenario because these firms are state-owned companies. Then it transmits to the sovereign as well. So it's important to keep that in mind. And there's also a whole section that deals with potential impacts to the government of India on a qualitative level. We're not saying anything about credit risk or country risk or anything like that, but there are some revenue risks that need to be, that we can conclude from this research. So without strategic responses, the firms included in our case studies face reductions in their free cash flows, which is what I was just talking about. And one thing that's important to understand is that this is not necessarily the worst case scenario. It could, renewables could rise faster. It'd be obviously very challenging. There's lots of research, there's lots of reports out there showing that there's grid stability concerns and things like that. But with the adequate investment and the adequate policies, it is technically possible that it rises faster. And if costs come down quicker, it could even happen just because it's economic to do so. And we found that if renewable energy capacity grows at 10% per year for several consecutive years, coal demand could fall even more quickly than we're finding in the results. So there's potential for bigger losses, and there's also significant potential for a peak in coal use in India before 2030. And this we find can happen even at lower levels of renewable capacity growth. And the 450 gigawatt target, if met and without much curtailment of this new renewable energy, peak coal could be a reality in the next decade or so in India, which is quite a stark finding. But of course, there's lots of uncertainties there, but it's something that is interesting to flag. And with that, I turn it back to Charlie, and thank you very much for your attention and for letting us, giving us the opportunity to share this with you.
Great, Alex, thank you. So I'll just say before we dive into the conversation is that, we had to make a choice in this work about how far do we go in terms of projecting out what will be the consequences of the analysis. And we stopped at with this metric of cash flow at risk. Certainly that could have been extended to actually firm level valuation. But I want to emphasize that particularly for an academic institution, our goal here is to not claim that we have the right answer. but rather to make a contribution and build a foundation upon not only this methodology that Alex and the team have developed can be replicated, could be used again, but also to build a foundation for a conversation and putting some numbers on the table and getting clear about what the magnitude of this challenge is in dollars and cents is ultimately what we aspire to. So we could have gone further. We could have stopped a whole lot earlier. But at least in this first report, we felt like this was the kind of numbers, that cash flow at risk, which in a cumulative basis for these three firms, we saw on a 10-year undiscounted basis being in the magnitude of $9 billion. And that's no small change, and certainly something that would keep any corporate manager up at night. So with that, let's move on to the conversation, and I'll do this one at a time. I have a question for each one of our panelists. It would have been in a live face-to-face. We could have been a bit more freewheeling. Zoom doesn't allow us to do quite as much, but so I'm going to just go one by one. So Amitav, if I could turn to you first. Amitav Borkakoti is the global head of risk governance and enterprise risks at Standard Chartered. He's been with us from the start in terms of the development of this relationship. And so, Amitav, if you wouldn't mind to reflect, I think first on how when we started to approach these issues and the bank, the conversation that you're having internally, how do energy transition risks differ from the other kind of risks that you manage all the time? I mean, managing risks is not a novel thing, but we would be really interested in understanding how this differs and how scenario analysis in the kind that Alex has shared, how useful do you believe that it's going to be in capturing these risks in terms of, its applicability, but also maybe its limitations. So Amitav, I'll hand it over to you.
Charlie, first of all, for all the participants and the attendees, and as Charlie mentioned, I mean, as a financial institution, this is a big priority for us. And going into the priority, we knew that we could not solve it alone. So we are thrilled to have academic advisors in this process because, this is a problem that we'll have to solve together. So Charlie, thank you for all the thought leadership from Imperial in this space. We really welcome this. We couldn't have solved this, or we couldn't have tried to solve this without your help. So just on your question, I guess, it is similar in some sense. It's also different. And I say similar, Charlie, because, when we think about our traditional risk in banking, credit risk, market risk, operational risk, we are thinking about climate outcomes within those lens. So if we think about, credit risk, is the counterparty's credit risk going to deteriorate? Is the credit quality going to deteriorate because of some of the cash flow you have highlighted? Because there'll be a dip in cash flow, probably because of revenue, or it probably because a huge amount of infrastructure investments needs to go into transition. So we are looking at it more in the lens of the traditional risk and how climate outcomes manifest through those risks, whether it's credit quality or stranded assets. Is the security that we have is really worth what we think we have, or is it lower than that, or is the credit quality lower than what we think we have? But in all of this, obviously, the big topic to focus is transition, as the research report highlights, and we are a big supporter of working an orderly transition, because if we go in a rapid disorderly transition, it creates other systemic risk for the industry and for the financial institutions. So orderly transition is going to be very important, and we will, using this report and other thought leadership that we are getting to, from our partnership, we will work towards transitioning clients orderly over a period. I guess being dissimilar, the horizon in which we are looking is different from some of the traditional risk we look. It's not a 1-year outlook that the credit quality might deteriorate in the next 12 months. It's a much longer horizon, and from that sense, it's quite dissimilar, and it's got its challenges in terms of how do you think about some of these risks manifest in the longer term horizon. I mean, this regulatory stress test, the Bank of England and the PRA is talking about a very ambitious stress test next year for all the in the UK registered systemic banks, and it's a 30-year scenario. And we have not done a scenario like that. We are used to doing a 5-year scenario, and that also after year 1 and 2, things become very, a lot of estimates and assumptions. So a 30-year scenario to see how different risk, whether it's transition risk in different sectors, manifest is going to be interesting. But I think the challenge for us is, although this is a longer term risk in some sense, but it's imminent and it's a real risk. And how do you price for this risk? How do you transition away the risk into opportunities is going to be the challenge. And in that sense, to your second part of the question, which is about the scenario analysis, is key, because we need those what if analysis, not just from a stress testing, but for our client engagements to say, if you were to change your energy mix from X to Y, what are the investments you need? How do we help you with those investments? But those investments will generate some cash flow pressures in the near term, but hopefully change the business model to reduce the reliance on some of the high emission business activities. So yeah, I think it's probably similar and dissimilar. I don't know if that kind of hits the areas that you are trying to get some insights on, Charlie. I can delve more further if needed.
Well, we'll have a chance to revisit some more of that, but I'll just say that that's a great starting point. I'll say one other thing, which I think is very interesting at the corporate level, which is around, as you make that transition with your clients, there's a real challenge in that what you're going to be replacing tends to be more capital intensive than what's there at the moment. So this ratio of capital expenditure to operating expenditure in a fossil fuel plant is very different than it is for a wind farm or a solar plant. And so it makes the appetite for banks like Standard Chartered even more critical, because without an ability to see that more needs to be financed up front, there's going to be an aversion to doing that. So I think that's maybe there's some questions already about that, and I think we can pick that up as we go on. Let me come to Ashish next. Ashish Fernandez is the CEO of Climate Risk Horizons. And Ashish, this analysis, you're no stranger to this kind of work. So what I want to ask you, and let's dive a little bit deeper. So you've been monitoring how the coal-dependent companies in India are moving. We've seen some big announcements even in the last few weeks. So very timely that we're coming out with this report, as and making some suggestions about actions that can be taken, and seeing some of those actions coming. But is that sufficient? And what from your view, what is the pace of change, and will these companies be able to do enough to respond to the threat of low-cost renewable power?
Thanks, Charles, and thanks to the Center for this invitation. And congrats to Alex and his team who worked on this report. I found it to be really well laid out, timely, and quite original. So it was really fascinating to read that last night. So coming to the announcements, I'll talk separately about NTPC and Coal India. So NTPC first, they recently said they will not build any more greenfield coal plants, which is a way of saying that we will not acquire new land, but we will continue to expand on the existing land parcels that we have. And if you look at what their projections are, they're still talking about building. They right now have about 12 gigawatts of coal under construction at varying stages, and another 7 gigawatts or so in the permitting pipeline, taking its total existing portfolio to about 70 gigawatts. In addition, there's another 20 gigawatts according to their plan that will come on stream. So I think what the report brought home to me was the fact that yes, they need to lean into the energy transition to minimize their risk, but they need to lean in even further than what you guys have proposed. Because if you look at where coal is right now in India, there is very little there's no economic or financial rationale to build new coal power plants. So why would this company that is India's largest energy company invest more money to build more coal power plants? They have initial construction plans. So construction has officially started on several power plants, including Khurja, for example, where they have a joint venture with another state-owned company. These are not going to come on stream for at least 5 years, probably, when the energy scenario is going to be even more adverse to coal than it is today. So how does that play into NTPC's credit risk profile? Financial markets are increasingly shut to new coal, both domestically as well as internationally. Green finance is what's growing right now. So if NTPC continues to seek finance as it has been doing largely for its coal build, what kind of impact is that going to have on the company? So what I would actually have loved to see in a projection on what the risk would be to NTPC's cash flow if it had leaned into renewables even more. So instead of a 30% renewable portfolio, what if they had a 50% renewable portfolio by 2030 or 2035? How much does that mitigate the risk, if at all? Projections like those, I think, would be really useful. Coming to Coal India, so Coal India's recent attention-grabbing announcement was carbon neutral by building 3 gigawatts of solar. This is the world's largest coal miner, so it's 600 million tons of coal. It's going to take a lot more than 3 gigawatts to be carbon neutral. I think it's basically to meet their own domestic, energy consumption in their operations, which is fine, but it's a really tiny amount. I think for Coal India, where the opportunity lies is we see in the aspirational scenarios that you've laid out that coal demand will largely plateau basically over the next decade, and it's not going to grow much. Yet Coal India still has this 1 billion ton target laid on by the government by 2024, going up from about 600 million tons today. So again, you're talking about a huge capex to increase to that level of production and the risk of stranded costs then. Does that need to be relooked at? If your coal demand is largely plateauing, then does Coal India has a huge opportunity to shut down its unprofitable mines, which account for only about 6 or 7% of its production, but a disproportionate share of its workforce. So there's a lot of cost reduction opportunity there that Coal India is just starting to explore, and they haven't done enough on. And the other option, I think, for Coal India is to re-examine the capacity, the capex it's spending on production expansion, new mines basically, in light of the more realistic demands of coal, given what the RE targets are. I think both of those in conjunction could actually reduce Coal India's costs quite significantly and allow them to give healthier dividends to shareholders, the largest of which is the government. And we know that the government needs, given the stresses of the last few years with the economy and coronavirus now, the government needs those additional revenue. So I think that is really quite a key thing to do for Coal India. It'll also boost its stock price, which has been in the doldrums for quite a while now. And of course, climate advantages and forest destruction, displacement of communities. There are all those win-win benefits as well.
Great, thanks, Ashish. We'll again, there's some questions that I think I'll pose to you after that are going to follow up, but it's really helpful to have those more granular insights. And you're right, there's a lot more. Any analysis like this is never done. There's a lot more flexing that can be done, and obviously events on the ground are changing. So we'll look forward to talking with you about how that might evolve and how the work that we've done actually could, an update potentially in the future could look at some of those more stretched scenarios as you just mentioned. Let me move on. Prasad Hegde, who's the Managing Director of Project and Export Finance at Standard Chartered. So really glad to have you here, Prasad. And of course, what we really wanted to get was that feeling, even that you're based in Mumbai and have an idea of, what's the word in the corridors in Delhi, in Mumbai, and in the corridors of power about, how big a problem is this, and how people are starting to understand this. And I think it's really interesting over the past year where, clearly there are certain financial capitals that are now staking a claim that they want to be the green finance leaders of the world. We haven't heard, Mumbai talking about that opportunity as of yet, and clearly you haven't had a chance to be roaming the halls as you would have previously. But maybe you could give us some insight on where you think this conversation is at, and really, how can some of these insights get into the minds of the financial system and market participants? And we'd be fascinated to hear how you think that might work.
Thanks. Thanks, Charlie, and hello to my fellow panelists as well as the attendees. I think I kind of completely agree with the assessment that Ashish just made about NTPC and Coal India Limited. I think from a financial sector perspective, if we were to look at the Indian financial sector, it's broadly dominated by local banks and financial institutions, whereas institutions like Standard Chartered and my fellow international banks, as well as DFIs and multilaterals, I would still say, a fairly small component of the overall financial sector in India. Now, I think if I just were to take a step back and kind of look at what the government of India has been trying to do, especially since 2014-15, and I think it's really commendable, the kind of targets that they have set for themselves, whether it's renewable energy, 175 gigawatts by 2022, and then again a 450 gigawatt number. These are very, very ambitious and lofty targets. But I think clearly from this, so there's this one arm of the government which is kind of really focusing on their commitments to COP21. I do think that by end of 2030, renewables or green energy will be more than the commitments that the government has made, that it will be 40% of the overall generation capacity in the country. So you have the government which is extremely gung-ho about clean energy, carbon footprint. And then on the other hand, as my fellow panelists mentioned, there are NTPCs and Coal India of the world. NTPC still kind of, although it is stated that they want to be a 30% green energy generation capacity by 2030, they still continue to build new plants. So I think there is a bit of a dichotomy in terms of what the government is achieving. And again, mind you, there is a bit of a federal versus a state, because it's the central government, the state governments need not always kind of agree on all matters. So I think in that sense, we do also see that there are a fair bit of state governments or the state generation companies who do have plans for setting up coal-fired power projects. So I think this is the dichotomy between the center and the state, if I may call it. Now, I think from a financial sector perspective, I think if you were to look at international banks like Standard Chartered and some of my other European as well as Asian banks, I think we obviously have a very robust sustainability framework in place. We had adopted our environment and social risk management policies. We were the first few banks to kind of say no to coal way back in 2018. And I think we've gone a step ahead and said that any clients which have more than 10% of their income reliant on thermal coal, we will try and not bank with those names. So again, and then of course we have made certain commitments between 2020 and 24, for sustainable finance as well as clean energy. So if you have international banks on one side, and then you have the Indian banks, they are not obviously yet signatories to Equator Principles or IFC performance standards. They kind of tend to happily keep lending or financing coal-fired projects. I mean, as Ashish mentioned, I think NTPC will still rely on a large part of their financing to come from the Indian public sector banks. So I think from a regulatory perspective, or as a financial sector regulator perspective, I think there are certain steps which are required to incentivize the financial institutions to actually move away from dirty lending to sectors which are going to increase the carbon footprint. And so to that extent, whether we can look at incentivizing some of these banks to kind of by looking at lower risk-weighted capital requirements, looking at sustainability linked loans and bonds where the banks pass on incentives to the borrowers if they kind of deliver on certain ESG performance criteria, and so on and so forth. So I think it's not a problem which can just be kind of fixed with by pushing the banks, but I think that all the stakeholders will have to play an equally important role. The regulator, the CEOs of all the large public sector banks, I think they will have to sooner than later adopt stringent policies and risk frameworks, ESG risk frameworks, so that they are in a position to push some of these large public sector companies in India to move in the right direction. And unless that really happens, it's going to be tough, because as you must have read in the press, in the last week of November, there was a large solar auction which happened, and tariffs have tumbled to 2.7 cents. And one of the large bidders there was NTP, one of the subsidiaries of NTPC. So I think, if you're going to start building coal-fired power plants, which will be up and running in 5 years, even today, I mean, the 2.7 cents tariff is almost half of what it would take to kind of have a coal-fired plant. The landed cost of power for a new coal-fired plant would be almost 6 cents or 5 cents. So you are looking at, and again, I think as silicon and wafer costs kind of keep, going down, there's expectation that they will fall further by another 20-25% in the next decade. You can yourself kind of see where solar powered as well as wind power is going to head it to. And so it just doesn't make sense to kind of keep on building some of these coal plants, under the pretext of having, I mean, it's more reliable, I think, but I think the sector needs to look at more alternatives, whether it's gas-fired peaking plants or any other battery storage. But clearly, I think building more coal plants is not the solution.
Thank you, Prasad. Let me, in the essence of time, let me turn very quickly to our fourth panelist, Kanika Chawla, who's the director of the Center for Energy Finance at the Council on Energy, Environment, and Water. Kanika, you are also no stranger to these issues, and I wanted to just ask you to touch on maybe some of the other issues at play here, because climate change has not been a major driver to date for the debate, the energy policy debate, but there have been overlapping issues around affordability, or increasingly around air pollution, and I wonder if you'd talk to us a little bit about that, and also what you see as the real role for organizations like your own, like academia, in terms of really, getting this conversation to the place that it needs to be.
Great, thank you, Charlie, and thank you to everyone at Imperial for inviting me to participate in this discussion. And let me join the other panelists in congratulating you on this very timely analysis. I agree with what Alex said up front around determining the scope of work like this is really quite hard, and there's a lot of assumptions, etc. But regardless, I think it's important to have an indicative direction of travel, and it's also a topic that we all know is really critical, and this transition is happening in India here and now, and the pace of it is something that we're all trying to accelerate through efforts, whether it's even within the government and definitely through institutions like ours and academic institutions. But we don't necessarily like to address the other half of the problem of what is going to be the impact of this transition. So I think that there is a lot of additionality in the work that you've done. So many congratulations on that. And I wanted to talk maybe about, as you said, two parts of this. One is how should you frame this and why is this work important? And then two, what is the role really of civil society actors? And so on the first, I want to say is that we all have focused a lot of our energy in terms of kind of making renewables and alternatives to incumbent fossil fuel-based energy technologies sort of, how do you get clean energy technologies to be viable has been kind of the focus for so long, but we don't, and our all of the above kind of approach to feed a growing, to feed our growing energy demand has brought us this far, right? And we are now no longer a nascent clean energy market. I think that we are a young clean energy market, but we're also a large clean energy market. And I think that the time has come to address some of the important trade-offs that lie ahead of us. And so one is in terms of just what have been the driving factors. And for most parts of the world, the big ideological shift on climate action and being climate compliant and Paris compliant is what drives the action towards clean energy and net zero technologies. Whereas in India, that is only one of the variables, and other variables around domestic value creation, around jobs, around energy security, energy access are perhaps equally, if not more important. And so that all then feeds into the role of civil society and academia is in building the right narratives. And because of the very highly politically charged nature of the discussion around thermal and coal, and because of the very large impact that they have on job creation and local value creation, it's just been one of those conversations that's been inconvenient to have. And so we haven't had it. So it's like, yes, we will do everything we can on renewables, and then we will just hope that everything works out for the best on incumbent technologies. And I think that the time has come to kind of address this challenge head on. And one of the reasons, of course, is the pressing kind of air pollution crisis that we have, as well as I think the kind of impact on the economic viability of existing thermal power plants that has only been exacerbated by COVID. I mean, we saw when India went into lockdown in late March, we saw that power demand kind of fell off a cliff and declined as much as 70% over a period of 3 weeks when we were in complete lockdown. But actually, thermal power demand went down by more than that, by about 80%, right? And a lot of thermal power plants were actually operating at utilization factors that were way below anything that we've seen before, even in their 40% range. And that's not something that is viable in the long run. And so I think that the discussions around phasing out thermal power and the use of coal is one, of course, do you really need more? And I think that's where there's, I would say in almost some majority, there is consensus that we're not actually going to build out as much coal as we thought we would. And in kind of the new pipeline, a lot of that is going to be green. And banks seem to suggest that even in the way that they're making their investment decisions, where a lot of the new exposure that they're taking on in the power sector is almost entirely green. And they're not taking this for any kind of green advantage, premium tax benefit. They're just doing it because it's good economics. And I think that India's overall energy transition has been very much one that's driven based on economic principles and market principles. And that's exactly the case that we need to keep making to kind of advance this transition away from thermal power. And your work is an important step in that. So I would say that the role that institutions like yours and mine have is one in kind of understanding the political economy and building the right narratives. And this include just transition narratives. Just transition cannot be an excuse to put action out into the future. You need to actually plan for it. The second one is on building the evidence to show that the economic case is actually in favor of transitioning. So you can't kind of just dig in your heels. And then is in implementation support, because I think that's an important aspect as well. I think that there isn't necessarily an understanding of how to transition, even if there is that we have to transition. And I think linked to that, and finally, I would say capacity building is another important aspect, both of actually financial institutions, including on financial regulation, as well as, of course, on market players within the energy system.
Thanks, Kanika. Let's keep building on that, and maybe because there's a couple questions here I'd like to put to the panelists, and so maybe I'll come to you first with a question posed, and maybe Ashish, we're interested in your views on this as well. As you were talking about just transition, the companies that we cover in this report are amongst the world's largest employers, and I think in railways might still be number one on that list. So that's a lot of people's jobs potentially at risk if this does not go right. And we'd be interested if either of you have some thoughts on how the government should be dealing with employment issues that could arise if this transition does not turn out right.
Right. Maybe if I can just go quickly before handing over to Ashish then, is I think that's an important point, and the way to deal with it is actually to size the problem first, right? And maybe that's a researcher's response, but I think that that's an important one, is to kind of understand how many jobs are we talking about, right? So, and it isn't, and what qualifies as a job, in the sense that, for instance, a renewable energy, if we were to get to the 175 gigawatts of installed renewable capacity, like you projected for 2025, where the number of people that would be employed full-time as workforce in just the solar and wind sector would actually be more than the number of people that Coal India employs today. And that number is anyway going down. But the quality of the job is different. It's contractual jobs. These don't necessarily come with homes and insurance and schooling and housing. But actually, there isn't this kind of multi-party understanding of what is the challenge. And I think that that's really the first step to addressing it.
Yeah, I think Kanika's absolutely right. Sizing the problem is key. So if you look at Coal India's current workforce, it's about 300,000, I think about 350,000 employees. And that is the big chunk. I mean, NTPC is relatively smaller. I think what's important is to realize that we are not talking, even in the most ambitious scenario, we are not talking about Coal India having to shut down even in 10 years. Coal India is going to continue to have to produce, maybe in an ambitious scenario, maybe not more than 600 million tons, but at least for the next decade and a half, probably 2 decades. So we do have the luxury of time in terms of planning this transition as far as jobs go. What does that mean? That means making sure that pensions and benefits are secured for workers currently in the workforce, making sure that as they recruit new workers, they have a plan for what the lifespan of that job is going to be. And I think the biggest thing is that the 2 things here. Okay, so Coal India needs to be made to live up to its commitments. You've seen the pattern in the West where coal companies go bankrupt and the first thing they do is they shed commitments to workers. That, thankfully, India has a different system and will not be so easy for Coal India to do, but I think that's key, number 1, for just transition. And number 2 is looking at, if you look at what Coal India can do in terms of creating a more diverse employment workforce, there is potential for Coal India to start investing in the renewable energy transition. They have a significant land bank. They have a lot of unused and expired mines that are no longer productive. There are potential opportunities there to explore in terms of what they can do in terms of pumped hydro storage. We know that storage is going to be key to the energy transition. Maybe Coal India has a role there. So there are things that they can do to start diversifying and continue to employ those laborers. And the third point I would make is that while we have 350,000 full-time employees with Coal India, the bulk of those are not good paying jobs, and they're not very healthy jobs either. So those jobs are there of necessity. If you give people an option and they have something else to do for an equal pay, they will quite happily take it because it's a less dangerous, less stressful kind of job.
We could go a lot further with this conversation, I'm sure, and the time that we've got for it is not enough. So I'm going to have to close because I want to make sure everybody gets on to their next appointment on time. But I want to first, so let me do a few thanks. First to you as panelists for sharing your insights. It really helps us a lot to ground this with folks that are doing this with every day and living this reality. Maybe more than we are on a daily basis, at least. I want to thank Alex and his team. It was a great assembly, a cross-disciplinary assembly of talent that stretched to a couple of other universities. So to the entire team that produced this report, I want to say thanks, and we really look forward to continuing to extend the insights that have been generated here. Dalia has gone ahead and put the report link into the chat. So really encourage people to use the short URL there to get access to the report that's up on our website. And we look forward to hearing from you more about ways in which this analysis should be extended in order to capture all of the complexities. And there's a lot more to do. And just to one of the questions that was raised, what about the second and third order effects? What about the supply chain? What about all of the other aspects? This is just one look at these specific companies, but these companies, as Alex said in his opening, are a systemically important part of the Indian economy. And this is not just about 3 companies; it's really about the entirety of a sector, and more than a sector, about a country that is, like many countries around the world, looking for a way to change and to transition. And really appreciate the insights that we've had from folks today. And finally, thank you to those of you in a very busy, and nobody wants another Zoom call these days, I know that. So really appreciate having over 100 participants on the call today. So we'll look forward to hearing from you. Again, thanks for your participation, and enjoy the rest of your day.